What if I told you that the traditional investment advisory industry is a massive, highly profitable illusion designed to systematically drain your wealth by convincing you to hire expensive financial managers to pick winning stocks when a simple automated computer system can easily outperform the absolute smartest minds on Wall Street? Welcome to Money's Hidden Past. Rich people lied. We fact-checked. Today we are stripping down the absolute mechanical reality of the index fund and exposing exactly why the most powerful financial vehicles on Earth are completely automated. When you look at the towering glass skyscrapers of the modern financial districts, you are conditioned to believe that generating wealth requires immense operational complexity. You see flashing electronic terminal screens and rows of intense mathematical data, and you assume that navigating this chaos demands a brilliant Ivy League mastermind. This calculated intimidation is the core marketing strategy of the financial elite. They desperately want you to feel completely inadequate and financially helpless. So you will willingly hand over your hard-earned lifetime of personal labor to an actively managed mutual fund that promises to beat the market average. But decades of cold, unvarnished economic data expose a deeply embarrassing secret. The overwhelming majority of these highly paid professional asset managers completely and consistently fail to outperform the basic baseline scoreboard of the economy, losing your generational wealth to hidden costs while losing the game to a computer. The revolutionary shift away from this extractive system began in the mid-20th century, led by a fiercely independent and deeply mathematical thinker named John Bogle, who looked at the aggregate returns of the traditional investment banking industry and realized that the entire active stock-picking business model was a statistical illusion. Bogle founded the Vanguard Group in the historical year of 1975 and successfully unleashed the absolute first retail index fund onto the public market, designed specifically to completely eliminate the expensive human stock-picking managers and replace them entirely with a simple, unyielding, passive computer algorithm. The powerful Wall Street establishment immediately laughed at his radical invention, viciously labeling the brand new passive vehicle as Bogle's folly across the media, and aggressively claiming that settling for the exact average return of the market was entirely un-American and a guaranteed path to complete financial mediocrity. The massive commercial banks ran aggressive promotional campaigns targeting the index fund, desperately warning retail investors that an automated basket was highly dangerous because it completely lacked a genius executive to steer the ship during market storms. But the calculated architects of Wall Street were actually motivated by intense raw panic. They completely understood that if the general public discovered the passive math, the highly lucrative system of extracting multi-billion-dollar management fees would collapse, and the elite would no longer be able to finance their luxurious private yachts using the stolen compounding interest of the ordinary working-class families to understand why the passive algorithm completely terrified the financial aristocracy. We must look directly at the elegant inner mechanics of a standard market index, which is essentially a static digital basket that automatically tracks a fixed list of companies representing the absolute foundational baseline of a specific national or global economy. The absolute heavyweight champion of these baskets is the Standard & Poor's 500, which continuously and automatically tracks the shifting financial performance of the 500 largest and most heavily capitalized corporate empires in the United States, acting as the supreme barometer of modern international industrial and technological production. When you purchase a single share of an automated Standard & Poor's 500 index fund, you are completely refusing to gamble your financial future on an individual corporate stock. You are instantly purchasing a tiny fractional slice of all 500 giants, simultaneously owning a piece of Apple, Microsoft, Amazon, and every other dominant market leader all at once. If those 500 massive corporations collectively grow in value over the years, your automated index fund increases in perfect lockstep with their underlying global production. And if those 500 companies suffer a temporary macroeconomic downward decline, your fund declines, with them ensuring you always receive your exact fair share of human progress. The computer algorithm utilizes a system known as market capitalization. Weighting meaning it automatically invests more capital into the companies that grow larger and more stable, while naturally shrinking its exposure to the struggling corporations that are losing their market value, creating an incredibly brilliant and completely free internal self-cleansing mechanism. If a dominant corporation suddenly stops innovating and begins to slowly decay toward bankruptcy, the automated computer program quietly and systematically drops them from the top 500 list, immediately replacing the dying business with a brand new, rapidly growing corporate titan, guaranteeing that your investment basket is permanently filled with the absolute winners of capitalism. A human mutual fund manager attempts to replicate this process using their own intellect, constantly buying and selling corporate stocks based on their personal emotional opinions and attempting to perfectly time the highly chaotic peaks and valleys of the global market. But this frantic human trading activity triggers a massive hidden financial catastrophe. Every single time a human manager executes a trade on the open stock exchange, they incur significant transaction costs, brokerage fees, and immediate taxation liabilities, which are quietly and aggressively deducted directly from the collective pool of investor capital, creating a massive structural drag on the overall performance of the mutual fund. Furthermore, the active mutual fund charges a heavy annual toll known as the expense ratio, routinely siphoning away 1 or 2% of your total managed portfolio value every single year to comfortably finance the expensive corporate headquarters and the multi-million-dollar salaries of the executives who are completely failing to beat the basic computer algorithm. A seemingly innocent management fee of just 1.5% sounds incredibly small, but when you compound that extraction over a working lifetime of 30 or 40 calendar years, that single parasite fee mathematically steals up to a full third of your ultimate nest egg, transferring hundreds of thousands of dollars of your labor directly to the banking elite. The fee does not just steal the immediate cash, it aggressively steals the future potential of that cash, because every single dollar the corporate manager siphons out of your account today is a dollar that can never completely generate its own independent exponential compound interest, effectively flattening your long-term growth curve and keeping you trapped on the corporate treadmill. An automated passive index fund completely eliminates this parasitic financial extraction, because a simple digital computer code requires absolutely zero multi-million-dollar bonuses, and it does not need a luxury company car or an expensive marketing department to operate, allowing the passive fund to offer an expense ratio that sits securely near absolute zero by keeping your internal structural management fees at a microscopic fraction of a percent. Nearly every single dollar of your hard-earned labor remains safely inside your account, acting as high-octane fuel for the unstoppable machine of long-term exponential compounding, ensuring that your money works significantly harder for your family than it does for Wall Street. Beyond the massive cost advantage, the index fund provides an impenetrable shield of diversification. The absolute oldest and most critical rule of financial survival is to never put all your eggs in one basket. Yet ordinary retail investors constantly ignore this rule by chasing individual viral stock trends, exposing their entire family security to the catastrophic volatility of a single corporate entity. History is completely filled with the tragic financial ruins of massive corporate titans, untouchable empires like Enron, WorldCom, and Lehman Brothers that completely vanished overnight, wiping out the entire life savings of millions of investors who blindly trusted a single company, leaving them completely bankrupt because they failed to understand the math of concentration risk when you deploy your capital into an automated Standard & Poor's 500 index fund. The sudden total collapse of a massive single corporation cannot ever destroy your financial future. If one company inside the basket completely fails and goes entirely bankrupt tomorrow afternoon, you still securely own the remaining 499 corporate giants to absorb the blow. The microscopic loss is instantly and effortlessly absorbed by the collective growth of the other giants, turning a potentially fatal economic nightmare into a completely unnoticeable blip on your dashboard. You are completely separating your financial survival from the fallible fate of a single business and tying your future directly to the collective productive output of the entire human species. If you still blindly believe that an expensive Wall Street manager can somehow beat this passive math, you must look at the legendary $1 million bet executed by the billionaire Warren Buffett. In the year 2008, the iconic investor challenged the absolute elite of the hedge fund industry, boldly claiming that no active manager could outperform a simple low-cost index fund over a decade. A prominent asset management firm eagerly accepted the bet, selecting 5 elite hedge funds which were packed with the absolute smartest minds and the most advanced proprietary trading algorithms. These elite managers actively adjusted their portfolios thousands of times over the next 10 calendar years, utilizing every single complex financial trick in the book to secure a victory over the computer. When the historic 10-year timeline officially reached its conclusion in the year 2017, the final mathematical results completely humiliated the entire traditional investment establishment. The simple automated passive index fund had completely and spectacularly crushed all 5 elite hedge funds, generating a return that was significantly higher than the actively managed portfolios. The hedge funds had generated an average return of only about 36% over the decade, while the boring automated computer algorithm had surged over 125%. The expensive experts were completely outclassed by a passive basket that required zero human thought, proving absolutely that active trading is a statistical losing game for the investor. This historic crushing happens because the modern global stock market is incredibly efficient. Millions of highly rational participants are constantly evaluating data 24 hours a day, incorporating every single piece of available news and corporate revenue directly into the public price, making it mathematically impossible for a single human being to consistently outpredict the collective mind. But the index fund is not merely a superior mathematical wealth accumulation vehicle. It is an incredibly powerful psychological weapon that completely protects you from your own brain. The traditional financial media operates entirely by generating continuous waves of artificial panic, desperately trying to trigger your biological fear of missing out, or your terror of an upcoming crash. This constant stream of sensory overload forces ordinary investors to make catastrophic emotional mistakes, frantically buying highly speculative assets at the absolute highest peak of a market bubble and violently panic, selling their long-term holdings at the absolute bottom of a temporary correction, voluntarily serving as the cheap exit liquidity for the highly patient institutional elite. An automated index fund completely cures this self-destructive psychological financial behavior by offering a beautifully boring strategy that is colloquially known as set it and forget it. You completely step away from the chaotic trading screens and refuse to watch the daily charts, knowing that you are absolutely not betting your hard-earned survival on a single volatile horse, instead of gambling your future. On an individual horse, you are aggressively buying the entire physical track. You are making a highly calculated long-term bet that human innovation and corporate greed will continue to move forward over the next several decades of human history, allowing you to sleep peacefully through the temporary storms of the macroeconomic cycle. The wealthy financial aristocracy desperately needs you to remain completely blind to this reality. They will continue to aggressively push complex, high-fee products and toxic life insurance policies, relying on heavy academic jargon and confusing charts to maintain the illusion of their necessity. Because your complete financial independence is a direct threat to their quarterly corporate bonuses. You must learn to completely look past the flashy corporate marketing and the elite tailored suits and embrace the slow, methodical, and incredibly unglamorous process of automated indexing, widening the gap between your income and your expenses, and pouring that gap into passive assets, letting the massive engine of global production do the heavy lifting. While you live your life, the history of money and corporate authority completely proves that complexity is the enemy of wealth. The people who demand constant action and fast short-term returns will always finance the luxury lifestyles of the patient elite who simply sit back and hold the permanent underlying equity of the global machine. Choose to stop playing their rigged active game and let the automated math secure your freedom. If this deep dive into the absolute mechanical reality of the automated index fund and the terrifying reality of how the traditional investment industry drains your wealth fired you up about taking absolute total control of your own permanent financial architecture, and then do me a massive favor, right? Now smash that like button to let the algorithm know this factual, historical conversation matters. Share this video with every friend and family member who needs to understand how the real financial world operates. Let us keep exposing the true mechanics of wealth and power. I will catch you in the next one, where we break down the next hidden chapter in the long history of money and corporate authority. Until then, stay informed, stay skeptical, and remember that the most intelligent financial move you can ever possibly make is to completely refuse to pay a premium to humans who cannot even beat a computer.